If you look at the major financial headlines right now, everyone is obsessed with the exact same shiny objects. The S&P 500 is ripping to brand new all-time highs. Bitcoin is behaving like a tech stock on steroids, and gold is moving like someone chugged a Four Loko and listened to a Joe Rogan podcast at 3 a.m. On the surface, the elite investment world is a playground of luxury. But while retail investors are busy chasing AI hype and buying up fractions of a Bitcoin, Wall Street's most sophisticated institutional funds are quiet quitting precious metals. Instead, they are hoarding an asset that is so incredibly dull-sounding it makes municipal bonds look sexy. I'm talking about copper. That's right. All those old pennies you have are currently triggering a massive closed-door bidding war among the people who think you are supposed to put shaved truffles on everything and live in $5 million Fifth Avenue apartments. After spending over 40 hours digging through global mining reports, industrial commodity data, and supply chain spreadsheets that made me question my own sanity, I found that copper isn't just outpacing some of the world's favorite asset classes, it's signaling a structural shift in the global economy that most people are completely blind to. To understand why Wall Street is treating a base industrial metal like liquid gold, we have to realize that copper is the literal DNA of human civilization. 5,000 years ago, it dragged humanity out of the Stone Age. We used it for tools, weapons, and early currency. Fast forward to the Industrial Revolution, and it became the literal nervous system of the modern world. Because copper possesses a near supernatural ability to conduct electricity and heat efficiently, you physically cannot build a modern city without it. It's inside your plumbing, your electrical grid, and every single appliance you own. Historically, economists gave it a joke nickname, Dr. Copper. They claimed the metal had a PhD in economics because its price was a flawless real-time health check on global manufacturing. If the world was building factories, copper prices went up. If a recession hits, copper crashed. It was a simple, honest rule. But recently, Dr. Copper has gone rogue. The historical rulebook was quietly threw it out the window. Copper is no longer just tracking old-school manufacturing. It has become the foundational infrastructure bottleneck for the two biggest investment narratives of our generation: the green energy transition and the artificial intelligence boom. An electric vehicle requires up to 4 times more copper than a traditional gas car. A wind turbine requires tons of it. But the real monster is the AI data center. Those massive computing warehouses require an astronomical amount of electrical grid infrastructure, and that means miles and miles of heavy-duty copper wiring. And that brings us to the math. Let's look at the data side by side, because the recent price action tells a story that traditional financial media is completely glossing over. If we look at recent performance metrics, retail investors think they're winning by holding standard portfolios, but copper has quietly been putting on an absolute clinic. It has aggressively outperformed the S&P 500 over key trading windows this year, leaving traditional stock pickers scratching their heads. Even when you put it in the ring with the heavyweight defensive champions such as gold and silver, copper has routinely stolen the spotlight. While gold has been hitting respectable all-time highs, driven by central bank anxiety, copper has experienced explosive, vertical trading sessions that look more like a speculative meme coin than a raw industrial commodity. And Goldman Sachs has had a front-row seat to the show. Their analysts aren't even pretending to be conservative anymore. Wall Street institutional consensus is projecting copper to blast past its previous records, with targets sitting at $12,000 to $15,000 per metric ton over the next couple of years. Some of the most aggressive macro funds are calling it the new oil, predicting a supply squeeze that could drive prices to astronomical levels. Why? Because you can design all the fancy software and AI models you want, but eventually, gravity shows up. You have to plug the data center into a wall, and right now, the global mining infrastructure physically cannot dig copper out of the dirt fast enough to meet the demand. The mainstream media wants you focused on speculative tech valuations and flashy headlines. They want you playing a game of musical chairs with overweighted and frankly far overvalued equities. But once you see this illusion for what it is, it becomes impossible to unsee. The real wealth in the next economic regime isn't just going to the companies building the software. It's going to the physical, unglamorous inputs that keep the lights on. Wall Street knows this. They are buying up the plumbing of the future while retail is stuck buying the hype. As always, this is not investment advice, and always consult a qualified financial professional before investing. Please hit like, subscribe, and hit that notifications tab. Drop a comment below. Are you holding commodities like gold, silver, and copper, or are you strictly sticking with traditional assets like stocks and bonds? Let's talk about it below, and I'll see you in the next video. If you liked this one, you might like this other one in the top left corner.